Good morning, everyone. I'm Pippa Clark, Tax Partner at Bishop Fleming, and I'm delighted to welcome you this morning to our Topical Tax Update. Thank you so much for joining us. You can see that I've placed myself against a backdrop of snowy mountains. Now, in normal times, this is probably where I would be this week, being half term. I'm sure, like me, you've all found yourselves in different places to where you expected. And businesses, of course, have had to be hugely resilient and react very quickly and be very innovative in times of significant uncertainty. One of the biggest changes that we've seen has been the landscape of government support, which does, of course, all have to be funded by taxes collected by the Treasury through the system. So the team this morning are going to share some topical tax highlights with you. You have an opportunity to ask questions along the way, so please do. You should see on your screen somewhere an icon with a question mark in it, so please use that to post questions as you think of them. I'll be chairing the discussion this morning and we'll deal with those questions at the end. And so it just remains for me just now to hand over to Wendy Andrews, our VAT Director, who's going to talk about some VAT issues. Wendy.
Thanks very much, Pippa, and good morning, everyone. Yes, quite a busy time for VAT and other indirect taxes at the moment, so I'm just going to take a bit of time to go through what's happening at the moment. Pippa mentioned COVID as a big current challenge for businesses. The other one that's obviously going on at the moment is the UK's exit from the EU Single Market and Customs Union from the 1st of January, which lots of changes. I've probably spent the last 6 weeks talking to a wide range of our clients about how they're being affected by what happened on the 1st of January. So I just thought I'd run through some of the main things which are emerging as the kind of key issues and key challenges really for businesses, particularly focusing on businesses who trade internationally in goods with the EU. The first one was slightly unexpected actually, and that's Incoterms. Before the 31st of December, Incoterms were quite important when you were trading with a third country. So if you were trading with a customer or a supplier outside the EU, it would be important to have your Incoterms straight, because those would determine who organised the international transport, who did the export declaration and who did the import declaration. And the convention really for trade outside the EU was that an exporter, the seller of the goods, did the export declaration, and the purchaser of the goods did the import declaration into their country. And perhaps rather naively, I'd kind of assumed that those principles would continue to apply for when the UK became a third country from the EU, that exporters from the UK would do export declarations and importers into the EU would do import declarations. That would have been the kind of expected pattern. And the biggest change, the biggest challenge really that we're seeing is that EU businesses who have been used to trading with UK suppliers within the single market and the customs union really are putting quite a lot of pressure on UK suppliers to carry on with that kind of trading mechanism. Very reluctant in many cases to get involved in doing import declarations into the EU, and putting pressure on their suppliers from the UK to do everything, to do export declarations and import declarations. That sounds very technical, but it actually does have very practical implications for UK businesses, potentially starting to mean that they need additional VAT registrations in each EU member state, because the thing about an import declaration is it's not although it's an importation into the EU, it's very specific to the member state in which it happens. So as I say, talking to a wide range of clients, their customers are consistently saying to them, please can you be the importer into our country, and that's got then lots of knock-on VAT issues and other issues. There are ways of dealing with it, but some of them are very expensive. There's a school of thought that EU businesses will gradually kind of get used to the idea that this is what they're going to need to do. But for a UK exporter who wants to be competitive and wants to have good relationships with their European customers, there is quite a lot of pressure to actually take the responsibility for dealing with all these new formalities and documentation. So following on from that are a number of EU VAT issues for UK businesses. The first is the one I just mentioned, potentially needing to register for VAT where customers are in order to be able to deal with importations, reclaim import VAT, and effectively make a local supply to a supplier. Other thing that's happening is that some of the EU VAT simplifications, which were very useful for businesses, don't exist anymore now that we're not an EU member state. The main one, and perhaps it's a bit early in the morning to be talking about it, the main one is called triangulation. And that's what happens when you're in the middle of a transaction, you're buying some goods from a supplier, say in Italy, you want them delivered to a customer in, say, Germany. When we were an EU member state, we could be in the middle from the UK of that transaction and effectively account for it so that no VAT needed to be charged. If you've got a middle party in that transaction who's not an EU member state, it gets much more complicated. And once again, similar pattern arising, the UK supplier is likely to be in a position where they're going to need to get a VAT registration, either where the supplier is or where the customer is, in order to deal with that. And then the final issue on the new EU trade rules is the question of origin. Not really a VAT issue, but really important. As you know, on Christmas Eve, the UK signed what was known as a free trade agreement with the EU, which does exempt from customs duty most goods transactions between the UK and the EU. But there was one important exclusion from that. And that's that the free trade agreement only applies to goods of UK origin going into the EU or goods of EU origin coming into the UK. So if you import goods into the UK from somewhere else, from the Far East maybe, or from the US, and you don't process them or manufacture them or anything, you just maybe repack them and then try to send them into the EU, those goods won't have UK origin, so they won't qualify for the free trade agreement. And another thing which lots of businesses are beginning to discover is that if you bring things in from a third country into the UK and then send them into the EU, it's possible that you'll incur a double duty charge, duty into the UK, which obviously isn't reclaimable, and then duty into the EU. Again, you can get around it, but it's quite complicated and quite expensive to set up customs warehousing or some kind of structure which will allow you to claim that VAT. Oh, apologies, not claim VAT, which will allow you to reduce the customs duty costs. So that's just a flavour of the kind of challenges which businesses are facing following the EU trade new agreement. A couple of other things going on VAT at the moment. From the 1st of March, the long delayed construction industry reverse charge is due to start. That was originally delayed from 2019 and then from 2020. But it is due to start on the 1st of March, and basically that applies to contractors within the construction industry. Contractors who are charging VAT on their materials and their labour, not who are working on building new houses, because that's zero rated, but commercial construction contractors who are making their charge to a main contractor will now not need to charge VAT, but their contractor will be responsible for accounting for reverse charge VAT on their VAT return. So anyone who's a contractor in the construction industry will need to work out where they are in that chain. Do they need to charge VAT anymore, or do they need to operate the reverse charge? It only applies to contractor supplies. If you're supplying an end user, like a company who's building a factory for themselves, you don't need to use the reverse charge. But as I say, if you're in a chain of contractors, you do. It's potentially going to have quite a big cash flow impact for businesses, because people might have been used to charging VAT and getting paid it, and then not having to pay it to HMRC until a couple of months later on a VAT return. If they don't have to charge that VAT anymore, that will alter their cash flows, and so quite important to be looking at that. Another delayed VAT development from last year, which it looks like is going to happen this year, is part of the implementation of making tax digital for VAT. Most VAT registered businesses started filing their VAT returns digitally from the 1st of April 2019. From the 1st of April 2020, a requirement for full digital links was going to be introduced, but that was delayed until the 1st of April 2021, which is now almost upon us. So it is important for businesses to make sure that they do have, and it's quite complicated actually to understand for businesses, making sure you have digital links throughout your VAT accounting process. Most businesses will be set up so they can file their VAT return digitally. It's now a matter of looking back down through the VAT accounting process to make sure all the links within that are digital. So basically, the thing to be aware of is to look out for any businesses who are using separate systems, maybe a booking system or a stock system, and who are then transferring data from that system into their main accounting system by copying and pasting something from a spreadsheet or by typing in some information. Those are the things which aren't digital links. So it's going to be quite important for businesses to review their systems and make sure they're doing that, because obviously for VAT inspections that take place after the 1st of April and onwards, visiting VAT officers will be looking to make sure that those digital links are in place. And although I think there's going to be what they call a soft touch initially, HMRC can charge penalties if that's not happening. And then finally, one of the COVID measures that was being introduced this time last year was a deferment of VAT payments from the sort of March, April, May VAT returns. Initially, the deferment was due to last until the 31st of March 2021, but to avoid a potential sort of cliff edge situation with lots of payments all becoming due at the same time, HMRC have introduced a deferment scheme which includes payments by instalments. So businesses who don't want to repay it all by the 31st of March can agree some instalment payments with HMRC. Basically, the fewer instalments you have, the bigger they'll be. The longer you spread it over, the smaller the instalments. And there is some detailed guidance now from HMRC on that. So that's everything I had to say on the VAT update this morning. So I shall hand over to John Sparks, who's going to talk about business tax.
Morning, everyone. Yes, a quick update from me on business tax matters. I think it's fair to say that we've seen an unprecedented amount of governmental support for the business community, not without criticism in certain sectors, but nevertheless, I think we would all agree it has been an unprecedented period for government support to businesses. The most important point to bring up with regard to the grants that have been available, so that's the COVID job retention scheme and the business rate grants that have been payable to a wide range of businesses, including the hospitality sector, is that those grants are taxable. So they will represent taxable income, whether that's corporation tax or income tax. There is one small caveat to that, which is around entities who have a tax exemption, so perhaps a charity or a mutual trading business. In those circumstances, you follow the principles that guide the taxation of that particular business. So the grant may be partially taxable or not taxable at all. The other area of support that we've seen for businesses has very much been around paying tax. Lots of areas around spreading tax payments, arrangements for overtime to pay, particularly around the 31st of January self-assessment deadline and also for corporation tax purposes. The other point to note is that the revenue have softened their approach around loss carrybacks and also the quarterly instalment regime for larger companies. So there is now a relaxed process around making early reclaims for corporation tax paid in a prior year where the company has been making a loss, or where reduction in profitability or loss making in the current year means that you've perhaps overpaid quarterly instalment payments. The revenue there are looking really for some fairly detailed management accounts to support an early submission of a corporation tax return. It's not something they, as I say, normally do or will normally accept. They refer to exceptional circumstances as allowing a business to make a claim under either of those rules, and I think we would all agree that the unprecedented times of COVID represent such an exceptional circumstance. The other point to note on losses actually is around charity trading subsidiaries. Charity trading subsidiaries, as I'm sure many of you know, will rely on the payment of gift aid to their parent charity to mitigate corporation tax. However, there is one rule there which may be an issue where the subsidiary has become loss-making in the current year, which is that in order to make their gift aid payment, the subsidiary requires distributable reserves. So, in other words, a bit like paying a dividend, the company must have sufficient distributable reserves to cover that payment. Where that's not the case due to the losses, then obviously the charity subsidiary will need to look at making an early loss carryback in order to be able to mitigate the tax for the prior year. So that's something that we've been working on very closely with a number of our charity subsidiaries. Wendy's mentioned some changes to making tax digital for VAT. One of the impacts of COVID has been that we've seen making tax digital being pushed back to 2026 for corporation tax. And I think that's also very much around capacity of HMRC to deal with that change internally. Another change that we've seen, which came in from the 1st of December 2020, is that HMRC have had their Crown preference restored. That essentially relates to a situation where you may have an insolvent company going into liquidation, where they owe money to HMRC, whether that's in VAT, payroll taxes, or corporation tax. For many, many years, HMRC were a preferred creditor. That changed a couple of years ago so that they effectively became an unsecured creditor along with everyone else. However, that Crown preference has now been restored. And I think certainly in the current environment with potentially increased liquidations off the back of COVID and the amount of tax that's potentially been unpaid, I think that's an understandable approach from the revenue to push for that preference to be restored. In terms of good news, we have seen some extensions to existing reliefs. So the annual investment allowance, which was scheduled to return back to £200,000 per annum, has been retained at 1 million, at least until the end of this current calendar year. And the new structures and buildings allowance, which was initially brought in at 2%, has been increased to 3% per annum to provide a little bit of additional capital allowance relief to businesses and to continue to encourage investment. Obviously, we've got a budget coming up fairly soon. Whether those, in particular the annual investment allowance, will be continued at £1 million, perhaps is open for debate, or whether it will actually ultimately return to the proposed £200,000 level. We will see when Richie gets up in a couple of weeks' time. The final relaxation that we've seen is a very important one around enterprise management incentive share options. Again, many of you will know that where companies issue EMI share options, the individuals who hold those options need to comply with a minimum working hours requirement. That essentially means that either they are a ostensibly full-time employee of the company that or the group that have issued their options, or that they spend, if they're not a full-time worker, that they spend the overwhelming majority of their working time working for that business. Given that some people will have been furloughed during the period of COVID, there has been a formal relaxation of that requirement for historic options that are already issued and options that are issued up until 5th of April 21. So that obviously helps where individuals have been furloughed and ensures that we don't have a disqualifying event, which obviously would affect the tax benefits of the EMI option schemes for obviously something that was never envisaged. In terms of employment taxes, the other key point to note is that we are also now going to see the extension of off-payroll working regulations being extended to large businesses within the private sector. That was originally scheduled to come in on 6th of April 2020, but was delayed by 12 months. So important for businesses to be reviewing their arrangements with their subcontractors and any sort of externally provided workers to make sure that they are clear who is responsible for dealing with any payroll taxes that may arise, and that they're comfortable that their employment status is that of a subcontractor rather than an employee. The other point to note there is the public sector businesses or public sector organisations. So that includes things like academy schools, essentially anyone who's caught by the Freedom of Information Act will already have been applying these rules from a technical point of view. However, if you've been used to applying them, there are some subtle changes to the operational rules for the off-payroll working regulations, mainly around the provision of information to the worker on the decision that's been made about their employment status and how that decision has been arrived at. So essentially, there's a more formalised communication requirement within the new rules that those that have been used to dealing with them need to be aware of. The last point that I'm going to mention is around some experiences that we've been seeing with clearances. So in particular, where you approach HMRC for a clearance around a share exchange or a corporate reorganisation, we've seen some tightening from HMRC around the rationales for those transactions, specifically around capital gains tax. Normally with those kinds of clearance transactions, you would need to explain in the clearance to HMRC the commercial rationale for undertaking the proposed transaction. And over the years, it's certainly been a regularly accepted commercial rationale that to, for example, put in a new holding company, asset protection of perhaps a property or cash that's in the existing trading company and moving that up to a new holding company is a perfectly acceptable commercial rationale. However, as I say, we've seen some tightening from HMRC, and particularly an argument being put forward by them that the movement of those assets up to the holding company for asset protection reasons is not actually a benefit to the trade of the subsidiary company. It's a personal benefit essentially to the shareholders by ring fencing the risk of those related to those assets. I think that's something that perhaps surprised some people in the profession, but certainly we've taken the approach that it's very important to focus on the commercial benefits to the company, which has essentially been something that we've obviously had that view for a number of years in any event, but I think it's even more important now that this tightening approach has come forth from HMRC. However, actually, one of our colleagues in our Exeter office has seen something issued by a tribunal where they have actually gone against HMRC's approach and suggested that protecting assets from the risk of a trading company failure is actually a legitimate commercial aim of undertaking a transaction, particularly where, for example, you have a management buyout type scenario where there is new management coming in or a withdrawal of historic management. So that was a particularly specific set of circumstances, but I think it's clear to suggest that HMRC's approach may not be entirely in line with accepted views on clearances. So that's everything that I intended to talk about from a business tax point of view. I'm going to pass across now to Matt Bennett, who's going to give you an update on R&D tax.
Hello, thank you, John. For anyone that doesn't know me, I'm Matt Bennett. I'm a tax manager in our Plymouth office. As well as that, I also sit on our firm-wide R&D tax credit group and our tech innovation and growth team. So as John mentioned, I'm going to give you a bit of an update on research and development tax credits this morning. So to start things off, just as a bit of a refresher, what are research and development tax credits? R&D tax credits are actively encouraged by the government. They're designed to fund innovation in the UK and to incentivise those companies that are undertaking research and development. There's a lot of qualifying criteria and conditions, but at a very high level, if a company is facing a technological uncertainty that couldn't easily be worked out by a professional that's in that field, and they're undertaking R&D to resolve the uncertainty that they're facing, then they could be in a position where they can be claiming additional tax relief. An example that I often go to is where you've got a food manufacturer that's looking at creating plant-based alternatives to animal-derived products or ingredients, and they're trying to achieve the same characteristics and taste and shelf life as the animal products, but in a plant-based vegan kind of format. A scenario like that, you've potentially got elements of R&D, so it's worth thinking about there. The benefits of claiming R&D tax credits is that for profit-making companies, it basically means that they get additional tax relief, which therefore reduces their taxable profits in the year. And for loss-making companies, they're able to surrender some of those losses back to HMRC to get some cash back. Talking about the kind of repayment of tax for loss-making companies, previously that's been uncapped, but this year, from the 1st of April 2021, HMRC are going to be introducing a cap. I mentioned that the losses can be surrendered. Just to kind of put that into context, it is 14.5% is the credit that they can claim back from the losses that are surrendered. So it's a valuable inflow of cash for these loss-making companies. So from 1st of April 2021, a cap is going to be placed on the amount of the losses that can be surrendered and the amount of the tax credit that is payable back to them. So the maximum that they will be able to get back in cash is £20,000 plus 300% of their total PAYE and national insurance contribution liability for any given period. So who's that going to impact? Broadly speaking, any company that's claiming a repayable tax credit of over £20,000 could be impacted. Those sorts of companies are ones where they have very few staff themselves. They use a lot of externally provided workers, agency staff, or they subcontract out a lot of R&D work. So their actual number of employees are quite low, and so their PAYE and NIC liability might be quite low. Another sort of example that you've got is where you've got perhaps a very small team of owner managers that are all taking low salaries out of the company, but they're doing all of the R&D work themselves. Again, because they're taking low salaries, they've probably got a very low PAYE bill, and perhaps then might not be able to claim as much cash back. It's not all bad news. Some companies won't be impacted. Companies that are claiming back under £20,000 won't be impacted, and there is an exemption. I'm just going to read this directly off the screen because it's a lot of words and I don't want to get the order wrong. So a company is exempt from the cap if its employees are creating, preparing to create, or managing intellectual property, and it does not spend more than 15% of its qualifying R&D expenditure on subcontracted R&D or the provision of externally provided workers by connected persons. Additionally, the cap just impacts the amount that is reclaimable as cash. It doesn't kind of get rid of any benefit entirely. If they aren't able to reclaim the payable tax credit, they can carry the losses forward against future taxable profits. So again, they don't lose the benefit entirely. It's just the kind of cash flow advantage that they're missing out on here. So if you've got clients that are claiming R&D tax credits, it's probably worth just making sure they're aware of this cap and that have got some things in place to make sure that they're thinking about it. Some other issues that I just wanted to touch on is our current experience with HMRC. Despite everything that's been going on, HMRC are prioritising repayment claims. They're still keeping to their 30-day timeline, and I've seen some that have come through in a week to 2 weeks. So they're still providing support to businesses in these challenging times. Something that we're also aware of is that a lot of resource has been moved around within HMRC itself. They are moving staff into the R&D teams. What that could mean for companies that are claiming R&D is that there could be greater scrutiny of their claims, more detailed checks, and then potentially more inquiries into R&D claims. Because of this, we're going through a process of making sure that everything we submit is completely expanded upon, and we're giving them as much information as we can, just because we want to mitigate any questions coming back from HMRC. Some other issues that are going on in the R&D world are some of the coronavirus support schemes. HMRC have kind of clarified the treatment of these. Some of the schemes that the government has put out are notified state aid. These include the bounce back loans, the C-bills and the CL bills. That just means that the R&D claim could be negatively impacted if you've got companies that have claimed under these schemes. Additionally, HMRC have recently won a tribunal where the company making the R&D claim was including work that had been subcontracted to them by another company. It's something that we've been aware of for a while, and it's always a scenario where you need to check the contracts and the agreements in a bit of detail. The tribunal just points that HMRC are picking up on this area a bit more than they were before, so there's just a need to have a critical assessment of any of these arrangements that might be in place. A couple of articles also have been doing the rounds recently, particularly in the construction industry, which has been suggesting that R&D claims might be possible where employers are making changes to the work environment to make them more COVID safe. It's not something that I've come across yet, but it's something that we might start seeing more of in the future. So if you've got a production line that normally has 25 people on it, and they're having to make technological changes that mean that they can only have one person working on the production line, then potentially they could be undertaking R&D activity there. As I said, it's doing the rounds in the kind of industry press, so it's something that clients themselves might be picking up. If you would like some further information, we do have an R&D knowledge hub on our website, which has a selection of videos, case studies, interviews and articles. It's always being updated, and I think someone should be posting a link to that in the chat window. As well, if you'd like some more information about R&D tax credits, we have a webinar coming up next week on Wednesday the 24th of February, and again there should be a link to that available if you do wish to attend. That's everything from me. I'm going to hand over to Dominic Carey now.
Good morning. I'm doing a little bit on personal tax and principally capital gains tax. And I think the headline first point that I wanted to cover was about entrepreneurs relief just getting badder, and essentially it hasn't just got badder, it actually got badder on the last budget day in March last year. BADR is business asset disposal relief, which has now replaced entrepreneurs relief. The headline point, I think the one that made all the news, was that the annual allowance, where your capital gains are taxed at only 10%, reduced from £10 million, not your annual allowance, actually it's your lifetime allowance, sorry. Your lifetime allowance reduced from £10 million to £1 million. So if in February last year you had realised capital gains of £2 million that qualified for the relief and anticipated that you still had scope to make a further £8 million worth of gains to use up your lifetime allowance, you suddenly discovered on budget day that you'd used it up already and there was no allowance left. But where you had not used any of it at all, your allowance, your entitlement to the 10% capital gains tax rate is now capped at £1 million worth of gains. The other entrepreneurs relief conditions continue to apply. So you've still got to have a material disposal. You've got to have a business asset that's disposed of, and it must be a trading business. Furthermore, you must also have a 2-year qualifying period immediately before the date of disposal. So the main crux of the legislation continues to apply, and it's worth always MOTing your clients to see whether they are in line to be able to pass these tests. I've very recently met a prospect here where they had traded for about 18 months, then stopped trading in that company, started a new company doing broadly the same thing, and had approached us for some advice about how to liquidate the first company and claim BADR, business asset disposal relief. Now, not only had they got a problem because they'd actually only traded in the first company for 18 months, so they hadn't met the 2-year test there, they also were walking into some anti-phoenixism rules, which you'll be delighted to know aren't part of my little talk now. So the second bullet point there is around about residential property and capital gains tax reporting. From 6th of April 2020, anyone disposing of residential property has got a 30-day period from the date of disposal to pay any capital gains tax due and file a new capital gains tax return. That 30-day period starts essentially from when contracts complete, which is normally, but not always, after contracts exchange. The requirement to file a return, it applies to individuals, to companies, to trustees, to personal representatives, to capacitors like deputies, and broadly it's something that we've all got to be on top of and adhere to. There are 2 routes that you can use for reporting your capital disposals here. There's an electronic filing process and a paper process where you can make a paper return. Now, in my view, the paper return process is a much more onerous route, especially given that you've got a 30-day deadline in which to file the returns. And you can be on the phone for hours and waiting for up to 10 days simply to order the paper form to complete and file. Having said all of that, you can only use the electronic route if your client has already set up a government gateway account and has then authorised you as the agent to help file the returns. Now, whilst that sounds rather complicated, as long as you've got an IT savvy client, that process is relatively straightforward. And I have to say, to be fair to HMRC, it's an extremely quick turnaround. They can set up a government gateway account, register to file a capital gains tax return, tell us, we send them a link, and within a couple of hours we can be authorised to take over all of that work, prepare the calculations, file the return, and have plenty of time in our 30-day turnaround deadline to get everything filed, submitted and paid. Now, not all disposals are actually reportable. There's no need to report transactions where there's a capital loss. If you've calculated that your capital gain is covered by your annual exemption, there's no need to report that. Or if you've calculated that your gain qualifies for the capital gains tax main residence relief exemption, there is no need to file a return there either. Now that's a seamless segue into capital gains tax. My third bullet point, just a couple of updates on main residence relief. Now, very briefly, main residence relief can exempt an entire capital gain on a disposal of a qualifying residence, a property that ordinarily you might have lived in and used as your home throughout the period of ownership. But we found that HMRC have been along with their valuations office agency, they've been getting tougher on a couple of key points where you're not dealing with a standard residential property disposal. And that's to deal with things like the permitted area and the curtilage of a residence. So if you have a home and on which, you know, with its gardens and grounds, it takes up more than 1.23 acres, which is half a hectare, that footprint is larger than the permitted area. Now, the permitted area is automatically exempt, but if you are occupying an area that is larger than your permitted area, it's very much up to you to claim capital gains tax exemption on what you consider your permitted area is, and where appropriate, pay capital gains tax on the balance of the gain. Now, permitted area is clearly a subjective point, but in a recent case where we've been negotiating with HMRC and its valuations agency, we found that the agency has taken quite a tough, and I'd say probably a little bit aggressive view on how big a permitted area should be, and you know, our opening gambit, as it were, was far higher permitted area than the valuation agency's opening gambit, and it took some negotiation to get to a sensible answer there. Now, similar issues around the curtilage of a residence, curtilage basically being the sort of the principal area around the home, which can extend to a number of outbuildings, and providing you can tick all the boxes, the curtilage of a residence can also be exempt from capital gains tax. But again, we've had similar challenging negotiations with the valuation agency on how close outbuildings need to be to the residence to stand a chance of being considered by HMRC as forming part of the curtilage of the property. So that's two major points. And the final point around capital gains tax and main residence is that we're still seeing occasions where HMRC are contacting people that have sold homes that are on garden and grounds that are larger than the permitted area, and no disposal has been reported. And it, you know, I can easily see why it's overlooked, but it is, I'd say, fairly easy, low-hanging fruit pickings for HMRC if they pick up that a desirable property, say in the South Hams or in Cornwall, has been sold and sits on several acres of land. There might be a paddock, there might be an orchard, there might be all sorts of peripheral bits in that property where the owner thinks they are only selling their residence, but technically for capital gains tax purposes, they may be selling far more than a residence and have far greater capital gains tax issues than may first be apparent. And I think the advice that I would give to anybody there is to make sure that you take advice before selling the property. And that was advice I would have given 2 years, 5 years, 10 years ago. But I think it's even more important now, given that you have a 30-day deadline for reporting and paying capital gains and a penalty regime that exists if you fail to do so. So that's my bit on capital gains tax. One of the advantages of presenting in a Teams format rather than standing up in front of you is that you cannot see that I am actually standing in Bob Bailey. Bob's our SDLT expert. I'm standing in his shoes to present a little bit and give you a little bit of an update around stamp duty land tax. The critical point here is that there is a significant rule change for people buying properties where the purchaser is a non-resident, and this isn't just limited to individuals either. So the rules will change on the 1st of April, and effective from that date, there will be a 2% surcharge on any residential property purchase where the buyer is non-UK residents. Now that will take the top rate of stamp duty land tax for non-resident purchasers up to a whopping 17% of the value of the property. There are a couple of sort of, needless to say, peripheral bits around this legislation. This legislation only applies where the property is solely a residential property. So a property for mixed use, a mixed use property, is not subject to this 2% surcharge. Needless to say, because tax is what it is, the rules for determining whether you are resident for stamp duty land tax purposes are not the same as determining residence for income tax and capital gains tax purposes. For stamp duty land tax purposes, you will be resident in the UK if you spend up to 183 days in a continuous 365-day period within 2 years either side of the purchase. So there's a little bit of wriggle room and certainly an opportunity to be resident in the UK for SDLT purposes when you are purchasing. But for those purchasing outside the UK who may be considering coming to the UK at some point in the not too distant future, it's certainly worth considering whether you can access UK resident status at the time you're or immediately following or shortly after you have purchased your property. And again, it's always prudent to consider that as you're going through the purchasing process. There's a couple of little quirky side bits of legislation around this. The rules are a little bit relaxed if you're non-resident purely because you're working as a Crown employee outside the UK. So basically, if you're working as a Crown employee outside the UK, the days that you spend doing so are not regarded as non-resident days. And in a situation where a married couple or civil partner couple are buying a property and one of them is resident and the other one is not resident, the resident party's residence position trumps the non-resident SDLT residence position. So that seems to me to be a sensible approach there. Now I think that's my slot on SDLT, and I'll hand back now to Pippa to wrap up. And I can see a few questions have come in, so you may well be hearing from any one of us again shortly.
Thank you, Dominic. Always interesting to hear from all our speakers, and what particularly strikes me about what Dominic has just said is that for a long time it's been quite a helpful thing from a UK tax perspective to not be resident in the UK, but now we have a position where that may be helpful for some taxes, but certainly for stamp duty land tax it could be very helpful to become resident in the UK, so a little bit of a tension there. Anyway, thank you so much for the questions that have been coming in. I'm just going to pick those up now. I think there's a question around VAT, so this will be for Wendy. Wendy, a question around the 5% VAT rate for hospitality. Do you want to just give us something on that, please?
Yes, thanks, Pippa. And it's interesting that there's been so much going on in VAT that the 5% VAT rate for hospitality, which would probably have been at the top of a presentation in a different year, sort of dropped off the bottom of my slide. So you'll remember that HMRC introduced a 5% VAT rate for hospitality, accommodation and some attractions in the middle of July last year, originally due to end in January, extended until the 31st of March, and I would have thought that must be quite a good bet for a further extension, possibly to be announced in the budget.
OK, thank you, Wendy. That's an interesting one, that the benefit, of course, isn't really available to the industry at all at the moment. So hopefully that is something that we'll see being extended in the budget. OK, another question that I'm just picking up now. Something about early loss carryback claims. John, I think this would be something for you.
Yeah, thanks, Pippa. So yeah, it's an interesting one just in terms of what information the revenue will be looking for to approve an early loss carryback claim. Essentially, the guidance talks certainly about seeing some management accounts and also, you know, the later in the accounting period that you're making the claim, I think kind of the more likely it is to be accepted, purely because essentially you're able to demonstrate and establish that that there is a pattern, excuse me, a pattern of losses in the current accounting year, which will allow you to more easily demonstrate factually that you've got a loss that you can carry back that's going to kind of at least be equal to or exceed the amount that you need to carry back to cover the profit in the prior year. So certainly the revenue will be looking for some pretty detailed management accounts. They will also be looking to see and consider whether or not you're likely to be making any asset sales in the period. So you know, for example, if you decide that you need to sell a property or a large piece of machinery or something of that nature, which or if it's an individual, whether you're going to be selling, you know, a share portfolio or something, so that you will reflect whether or not you've actually got any other income coming in that will impact on your profits for the year, from another source, so which obviously may then offset the loss in the current year rather than allowing it to be carried back. It's also worth noting that because you are making the claim through submission of a tax return, albeit it's an early tax return with management accounts rather than the sort of the traditional statutory accounts, the revenue do have the right to inquire. So if they look at it and see that you have questions or see that they think that they don't have sufficient information to make the decision, then they can inquire to ask for further evidence to support the losses in the year. So yeah, I think the short answer is fairly detailed information, and in some respects the more clarity you can give to HMRC on the business situation, the better.
Thank you, John. I think it's a really useful measure that there will be a facility to carry back losses and claim those tax refunds early. I'm sure a lot of businesses will want to take advantage of the cash flow benefits that would bring for them. Looking at some of the other questions that we've had, something around the residential property changes and the new CGT returns. Dominic, that can be quite challenging if you've got a valuation that you're relying on and that leads you to one conclusion, but actually on investigation, HMRC perhaps successfully challenges that and leads you to a result where you would have tax and so there's a return that's been missed. What's the position there?
Yeah, that is a good question, and it is one that I'd say we're probably in uncharted waters on at the moment, because the likelihood is that HMRC will pick these issues up through self-assessment return reporting or through a subsequent sweep of property disposals and trying to match them with capital gains. I've certainly had situations with clients already where we've looked at capital gains tax calculations and using valuations and or estimates where there's been some enhancement expenditure for a lot of people. You know, you can have owned a property for a long time, spent significant money 10 years ago on putting a brand new roof on and not bothered to keep the receipt to support the expenditure. So there'll be plenty of return or calculations that will be based on valuations and estimates. And I think my view at the moment is if you get to a point where your estimates could be vulnerable to a big swing, if it were me, I would file your capital gains tax return to report no capital gains tax to pay, because I think at that point, at least then you have benchmarked it, you've put it out there and you've said this is what we think, rather than HMRC potentially picking up on that point through a self-assessment tax return 12 months later and coming to you and saying, well, actually we think you should have filed a return in any event. I think in time it'll become clearer where they are on that, but I think my view would be to be a little bit safer. If you feel there's a risk of a debate and a risk of capital gains tax to pay, I would file a return and be very front foot on that. The return actually does require a disclosure if you've used valuations or estimates. So you would be making that point very clear. You can make that point even clearer in the calculation that you can attach to the return when you're filing it. And that way, I think you've given yourself the maximum possible protection for the risk of HMRC charging penalties, because I think there you have been absolutely transparent in it. So I think that's where I would be, which would be just to be very front foot with the disclosure.
Okay, thanks, Dominic. So the advice would be to file a return even if on the face of it it looks like a return may not be due, where you're relying on valuations to do that. Okay, thank you. Just having a look to see what other questions we've got. Okay, there's a question about the cap coming in on the 1st of April and what happens if that's a December year end. So I think that relates probably to the R&D side of things. Matt, would you like to take that question?
Yeah, that's fine. I'll try and keep this quick as the bin lorries have just appeared outside my house. Yeah, so if you've got a period that straddles the 1st of April, you effectively kind of just split that period and undertake a calculation up until the 31st of March, and then a separate calculation for 1st of April to whenever the end of the year is.
Okay, thank you very much, Matt. That's a straightforward answer then. It's a time apportionment that you would be dealing with. Okay, well, we do have the budget at the beginning of March. We will be hosting a budget event on Thursday, the 4th of March, and I would encourage all of you who are joining us this morning to register for and attend that. We should be able to put a link to that in the chat. You know, this is the most uncertain landscape that I think I've seen in the tax world throughout the whole of my career. We have significant changes being talked about. I think it's been quite widely reported that the Chancellor is definitely preparing the way for some tax rises. We don't know quite what form they'll take or when they'll come in. There's certainly a school of thought which talks about those sorts of measures being delayed because the last thing anybody wants to do is to stifle the economy, which many economists are saying that there is some good pent-up demand in the economy, which should, as soon as it's possible, allow some significant economic activity, which in turn would generate some tax receipts. But you know, there are things being talked about that would be fundamental and significant, some wide-ranging changes on the capital taxes front, for instance, whether that's increasing rates or simplifying IHT, or even the potential for an introduction of a wealth tax, which some other countries have looked at doing as a temporary measure to supplement the Treasury coffers, as it were, when there's so much that has had to be given out. So please do join us for the budget event on the 4th of March if you can. We haven't had any more questions come in, so I think that just remains for me to say a big thank you to our presenters. That's been great to hear from you all this morning. Thank you to all for coming and joining us, our audience, and to wish you all a good day. Thank you.